it's not magical, but the TBA market sure works well and greases the skids. And without it, it would be very difficult to see a model where everyone can continue originating.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
Hello, everyone. Today, we're going to talk a little bit about liquidity in the mortgage and mortgage securities market. It's something that I've been involved with my entire career. Something so important that's understood by so few people. And so I want to take some time to talk about how it actually works and what the impacts of liquidity are on the market. So starting out, I think everyone understands that mortgages are originated at certain rates with fees and so forth, and the borrower closes on the loan and it goes through the process to go to, let's just say, Freddie, Fannie, and then into a mortgage-backed security. The part that's the most important is that folks on the front end that see rates and fees don't necessarily understand how that's possible. And so let me go over it. Freddie and Fannie were created in order to provide liquidity to the market. So what do? They provide the ability for loans to be bought and sold through to the capital markets. And how that works is fairly straightforward. They have what's called a TBA market, and it's literally to be announced. And what does that mean? That means that they post pricing for the mortgage-backed securities ahead of time. And at one point during the month for 15-year and one point during the month for 30-year, people can buy and have delivered these mortgage-backed securities. Now, when you say TBA, that means I'm buying something that I'm not exactly sure what it is, but I do know that, say, for example, it's a 30-year, 3.5 mortgage-backed securities. So the magic with that is that you don't have to exactly understand what loans are in what securities ahead of time. And naturally, as the pools and securities are created along the way, it may or may not be the best loans in the bunch, but because people are willing to buy it ahead of time, it guarantees that those loans are going to move through the pipes. So that said, when you go back from the TBA pricing, it goes out in terms of what Freddie and Fannie will be able to buy on the loan side and into what security, say 30-year, 3.5. And from that, it goes back to the lenders, and they look at the numbers and they're able to say, well, okay, given what I need for my costs, I can then translate that back to what I put on my rate sheets to the loan officers, to the brokers, to the buyers. And that's how it works. But again, the magic with liquidity is it guarantees that there is a place for all of those loans to go. So let's just pretend like there wasn't a TBA market and Freddie, Fannie weren't the buyer of last resort. What would happen? Well, you would, as a lender, you would have to figure out how to sell these loans into the market. And maybe what you're originating doesn't have a buyer. Well, that means that not all of what you're pulling through your pipeline is going to get sold, which means you have to keep it on your books. You have to service it. There's a cost of that on your balance sheet. And at some point, you're going to be over the limit for what you have in terms of capacity to loan more. And so what does that mean? That means that you can either raise prices or limit the loans that you're originating. And it just really, really damages the supply chain. So again, liquidity, very simple concept. it enables a market that allows for that pipe to move fluidly. And let's just say, for example, that the end buyers of these securities, maybe the appetite's not as great. Well, historically, Freddie and Fannie would then say, okay, I'll buy them anyway, even though I can't forward sell them, and put them on my books until eventually the market picks up, and we can get rid of them. And as people know, when the retained portfolios at Freddie and Fannie shrunk, the Fed went in and said, well, I'll just buy all of them. And so again, you look at this market and it's not magical, but the TBA market sure works well and greases the skids. And without it, it would be very difficult to see a model where everyone can continue originating as fast as you can, and as often as you can, enabling home buyers to be able to live in a home that's what they need at a price that makes sense. So again, without the TBA market, without Freddie, Fannie, Ginnie, the liquidity could come and go, and it would really, really impact the market. But because of it, it's very fluid, and it enables that conveyor belt, as I just mentioned a minute ago. So hopefully that was a little bit of an insight into how liquidity works in the mortgage space. And we'll probably have some additional things that come after this. So thanks a lot for your time.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.